first Professor Perry Mehrling. We are very privileged to have him here. He wears many hats. He's a professor of economics. He's also one of the key figures of the INET Institute for New Economic Thinking. And he has, one of the reasons we invited him here is that I think he has laid the foundations for thinking about the new model of central banking. And he's done that through his recent book, The New Lombard Street, and also through his American Economic Review paper, Three Principles for Market-Based Credit Regulation. The second speaker is Manmohan Singh from the IMF. He's written extensively on collateral, and indeed lots of the things that we know about collateral comes from Manmohan's research. So welcome to both of you, and Professor, if you want to start.
Good morning. Thank you for that introduction, and it's now 5 past, so time is an issue. So this is the book that Danielle was referring to in a bookstore near you. I put this in the first slide because I want to emphasize that I think that the time today, this time in history, is very much like 1873, okay, when Walter Bagehot was writing the Old Lombard Street, a description of the money market when the pound sterling was the center of the global financial system at that time. And when the Bank of England, he was reflecting on what the Bank of England had done in previous crises, and he was saying to them that, you know, guys, what you have always done is lend freely at a high rate against good security. So why don't we make that a rule? Okay, why don't we just admit that and make that the foundation? And this is really, from my way of thinking, this was the moment at which modern monetary economics sort of started. Because once the central bank takes responsibility to do that, it then says, well, if we're going to do this in a crisis, let's try to prevent crises in the first place by prudential policy or maybe countercyclical policy, and everything was built on top of Bagehot, okay, up to 2007. And so I am proposing that we need to go back to Bagehot and go back to that level of fundamental thinking and say, well, what is it that worked to get us out of this most recent crisis? Let's bring that up to consciousness and then think about how should we build monetary economics on top of that, okay, over the next century. We're living in a Bagehot moment. So I want to emphasize that I think of shadow banking as the characteristic institutional form of the modern monetary and financial system. It is not an aberration. It's not regulatory arbitrage. No doubt there's some of that stuff going on, and fraud and all that sort of thing. But I'm actually thinking that there are good reasons why there's shadow banking. And what do I mean by shadow banking? That's my definition there. Money market funding of capital market lending. Wherever we see money market funding of capital market lending, that's the phenomenon I'm interested in. Sometimes this is on a balance sheet of something we call a bank. Sometimes it's on a balance sheet of something else. Sometimes it's in a trust or a sieve or something like this. You know, wherever we see that, okay, that's the phenomenon I'm interested in. And there are 4 dimensions of this that I'm going to be talking about. This is a global system, global on the funding side, global funding of local lending. That means there's often some FX risk, okay, which we'll come to at the end. These, on both sides of the balance sheet, both the funding and the lending, we're talking about prices that are determined in competitive markets. Market pricing of both the money side and the capital side. The third, that means that there's some sort of a market-making institution that is quoting a bid-ask spread, that there's an order flow that's pushing this price around. We need to understand where those prices come from. And then fourth, the central bank comes into the picture as a backstop for these market-making institutions. That's the key. Not for the shadow banks themselves, but for the institutions that make the prices. I'm going to elaborate all of these points in the next 33 minutes. This is the one diagram that I would ask you to, as a takeaway, And I'm going to be going through it in some detail and explaining it. But this is my image that I would like to leave you with of how to think about the modern world. This is what I'm hoping will become useful for regulators and for central bankers as we're trying to have a roadmap or a framework for thinking about what needs to be fixed and how do all the pieces fit together, okay? Because we heard yesterday, and it's quite true, that Dodd-Frank is basically a laundry list of everything that's wrong in some little, but it is not coherent, okay, as a document that has some conception about where we're going. I am imagining that this is where we're going, or some version of this is where we're going. And what am I showing here? Up on, I think I have a laser pointer here. Let's see. Yeah, okay. So this thing that I call the capital funding bank, you see what it's doing. That's residential mortgage-backed securities, capital market lending. That's money market funding. That's money market funding. So this is a shadow bank that we're talking about here. There's other pieces of this. The funding piece is global, and I'll come to that. Okay, these things here are derivatives. So these are taking the risk, stripping the risk out of this residential mortgage-backed security. Credit default swaps, interest rate swaps, FX swaps if it's in some foreign currency. And there's a whole market in this risk that's down here too. I'm going to talk about some of that. But so this is the phenomenon, shadow banking, that I'm interested in understanding. And the role of the central bank, where does the central bank fit into this picture, is the question that I want to address today. You'll see in that picture that this is an idealization. I'm abstracting from, there are no retail depositors in this picture, no direct investors holding stocks or bonds, no traditional banks, Jimmy Stewart banks, at all. I'm abstracting from the securitization process and all the problems of self-dealing that might come to underwriting, buy to distribute kind of problems. And I'm not going to say anything about those for the rest of the 30 minutes. I will say some things about the next two items, but at the moment I'm abstracting from liquidity reserves, I'm abstracting from capital reserves, and I'm abstracting also from proprietary dealing. In a way, my dealers here are Volcker rule dealers. Okay, they are matchbook dealers right here, where they have the same risk exposure on both sides of their balance sheet. They're not actually taking a proprietary position. That is sort of impossible, as we'll come to, but this is a starting place. You will note, and this is just a teaser for later, you'll note that the only capital in this system is here on the balance sheet of this asset manager. This is an idealization where you're imagining that you can actually strip out all the risk. So this is riskless, and so you're funding a riskless asset here, and somehow that's passing through here. And here, this is also a matched book, so there's equal risk on both sides. So there's no need for any capital anywhere. All of the risk is here. These are the risk exposures: credit default swaps, interest rate swaps, FX swaps. This again is an idealization, but I just this is to sort of get you in the frame of this talk as by comparison to last night. My banks, my shadow banks, have no capital, so they have an infinite ratio of debt to equity. But they're perfectly safe because it's riskless stuff that we're talking about. That's sort of provocative. Okay, so we're abstracting from these things in order to focus on system interlinkages, liquidity risk issues, and not solvency. We're starting from liquidity. So this is a definition of shadow banking, money market funding of capital market lending. This isn't how people normally use this word in the regulatory world, okay? They tend to be using it, emphasizing the shadow, okay, the dark side, okay, that it's regulatory, the unregulated part of the banking system maybe is the shadow part, okay, or the part that has unauthorized access to the taxpayer or something like this. So there's something that's where how the language often is used. And people can, make words mean whatever they want, but I'm going to use it in this particularly precise way. And the reason I am, and this is what I want to come to here, this point, okay, is that I want to be thinking, and partly this is an intellectual exercise, but I actually think it's sort of true, or I will at least assert that it's true, that shadow banking comes from two phenomena in the evolution of banking. One is financial globalization. that this is a natural form of banking for a globalized financial world. And the second is that it comes, or that it's enabled by the financial revolution, the set of ideas of CAPM and arbitrage pricing theory and derivative pricing theory and all this sort of thing. My previous book, here, Fisher Black and the Revolutionary Idea of Finance, is where I learned all the finance that I know. And in a way, the New Lombard Street is trying to bring money into the picture of finance. You'll see that. So I'm imagining a world, and I want you to sort of participate in this for the next couple of minutes, okay, in which there's only shadow banking. There's no traditional banking system, there's no Jimmy Stewart banking, there's nothing, okay? There's only shadow banking. And why do I want to imagine that? Because, think about how would we regulate that? That's a way to get in your mind a system where you're not going to have any regulatory arbitrage because it's only shadow banking. So we're just regulating shadow banking. And we're not pushing people from traditional into shadow banking or shadow banking into traditional or something like that. So, and in fact, this isn't so far from the truth, as a matter of fact, in some countries anyway, as a source of credit, shadow banking is more than half in the US. So that's the exercise we're doing today. The conversation about shadow banking, I want to just note this, where this connects up with the regulatory discussion is mostly in Workstream 5 of the FSB. And in particular, here's a quote from the description of Workstream 5. Securities lending and repo markets play crucial roles in supporting price discovery and secondary market liquidity for a variety of securities issued by both public and private agents. This is the world, this is the stuff that I'm trying to understand today. So now just some theory. What I want to for many of you, this will be sort of elementary, but I think it's important to remember this. So let's talk about the difference between solvency and liquidity. And I'm comparing two balance sheets here, one that is largely equity finance, 90%, not 25%, and one that is largely bond finance, okay, 90% bond finance. And so this is more leveraged than that, okay? And that means that if these future earnings don't appear, you only have loss absorption of 10, and if you lose more than 10, then you're a put on the government or something like that. That's the solvency sort of issue. And I'm not going to talk about that at all today. Okay, I'm interested in the liquidity issue, and so I'm comparing this bond finance with money finance here, where you have bonds that are funded with deposits. So this is a shadow bank here, right? This is sort of capital market lending with money market funding. And the issue is that is a maturity mismatch, but maturity in a particular cash flow sense that I want to emphasize, which is that their cash outflows can and do, they happen every day. If these are, particularly if this is, say, 3-month funding, okay, you roll this over every 3 months, whereas the bonds don't roll over every 3 months, and so there's a liquidity risk piece to this. I mentioned Minsky here, his distinction between hedge, speculative, and Ponzi finance. I interpret Minsky not as a story about leverage, but as a story about liquidity, okay? That it's about matching your cash flows in time, cash inflows and outflows in time. Hedge units are units which have cash inflows in every period in the future greater than or equal to their cash outflows, and so they can't ever have a liquidity problem. Speculative and Ponzi can. So it's the essence of banking, in a way, that you expose yourself to liquidity risk, and that's where the profits come from. That's what I'm going to be, so the focus of today, as opposed to last evening, which was really all about solvency, I'm actually talking really, starting from the other end of the story, from the liquidity story. But we need to talk about modern liquidity, okay? This is the same balance sheet I had in the previous slide, bonds financed with deposits or term funding of some kind. And now compare this. Think about this. Think about a shadow bank where the bonds are funded 100%, okay, there's no equity at all, and you're stripping out all the risk with a credit default swap. And some other person over here is holding that risk and is helping you fund your stuff with $10 worth, and there's equity of 10. Now, I want you to observe that if you were to consolidate these two balance sheets, okay, it's exactly that balance sheet. if you were to consolidate them, right? 100 minus 10 is 90, okay? And these credit default swaps would drop out. They're on both sides of the balance sheet. And so it's the same. There's equity of 10, and there's deposits of 90, okay? It's the same aggregate exposure, but it's pulled apart, okay? And so now there's this issue of liquidity where these deposits have to be rolled over, and maybe this asset manager won't roll them over. Okay. There's also this issue, these credit default swaps are going to fluctuate in value, and there's going to be mark-to-market and margin payments and stuff like that. And so collateral is going to have to flow, and maybe that's not going to flow, or there's going to be some problem there. Okay. So these are the issues. This is where the liquidity enters into the system, and this is modern liquidity, I say, not old liquidity. You know, when we think about banks here, typically we're just thinking, well, maybe some retail depositor is going to pull their money out, or they're going to run, or something. This is modern liquidity. These issues here. Okay, wholesale funding markets and mark-to-market for derivative of exposures. This way of thinking about the world gives you a different, you're going to have a few different definitions of money and banking. So here are my definitions of money. When I say money, I mean transferable credit. Okay, I mean inside money, a form of credit, not outside fiat money. I want to observe that this form of money is some of it's public, okay, like deposits at the Fed. Some of it's private. Most of it's private. Deposits at other banks or non-banking entities. That the payment system I think of not as a matter of little green pieces of paper, sort of with velocity floating around and clearing things, but it's offset of credit in a clearinghouse, par credit clearing. This is a natural way of thinking. It won't, I mean, I see industry people here nodding. There's a natural way of thinking about money in modern finance, but it's not actually what's taught in the textbooks very much in economics. The second thing is banking. Banking in the textbooks is often treated as if it's all about intermediation, saving flowing in, investment flowing out. I'm going to think about banking as the essence of banking being a swap of IOUs. Okay, that one way to think about that is that loans create deposits. So what is that? The bank says to me, I owe you $1 million. That's a deposit account, okay, which I can use to buy a one-bedroom apartment in Manhattan, okay. And I say to the bank, no, I owe you $1 million, okay. That's a mortgage, okay, and that's a swap of IOUs. Okay, that's the essence of banking, is this swap of IOUs that's going on here. Once you think of banking in that way, you see off-balance sheet derivatives as natural banking assets. So an interest rate swap is just a swap of IOUs. I pay you fixed, you pay me flex, okay? A foreign exchange swap is just a swap of IOUs. A credit default swap is just a swap of IOUs. They're all swaps of IOUs. These are natural banking assets, and they're here with us for the future. They're not some strange creation of Wall Street wizardry meant to bamboozle us. Maybe they have that effect, okay? But we have to get used to them and regulate them. This is the world we live in. This is the point. Thinking of banks in this way, too, I want to emphasize that I'm not thinking of banks as intermediaries, but thinking of them as dealers, banks as money market dealers in particular. And here's another picture of the hierarchy of money and credit. So there are actual dealers, security dealers, who are making markets in securities, that is to say, a bid-ask spread, saying they'll go either way. If you want Apple stock, I'll sell it to you. If you want to get rid of Apple stock, I'll buy it from you. That's a security dealer. Banks are just dealers at a higher level in the system. They're dealers in money. If you want a deposit account, I'll give you a deposit account. If you want a loan, I'll give you a loan. If you want to go long an FX swap, I'll sell that to you. If you want to go short. And central banks are also dealers at a higher level in the system. And the prices that are being made by these dealers are sort of, you can think of them sort of stylistically as these three prices of money: the exchange rate, the price of domestic money against foreign money, par, the price of public money against private money, and the interest rate, which is the price of securities. That's a hurry-up little refresher. So now here is the central diagram again. So this is the way I want to think about the modern, this is the framework, as Daniela said, for thinking about the modern collateral-based banking system. I mentioned when I first showed you this that this is the shadow bank. I'm now calling it a capital funding bank so that it doesn't seem shadowy. And it is, to remind you, capital market lending money market funding here. But now we have a few more concepts, and we can build the rest of it and say, well, this money market funding is coming from a bank. I'm going to call this bank a global money dealer to emphasize that they're a dealer, which is quoting bid-ask spread, and so it's letting that order flow move its book around, and I'm showing it having a matched book such that deposits on one side and money market funding on the other side. And then there's a derivative dealer, which is making markets in these risks here. So these liabilities here are the counterpart of these assets here. And then this I haven't talked about, the asset manager. So this might be a pension fund. This might be an insurance company. And I'm imagining that this pension fund is getting all of their risk exposure with derivatives, okay? They're not buying any securities outright. They're getting all of their risk exposure with these derivatives here. If you know, I'll just remind you in modern finance, okay, that a long position in deposits and this risk exposure here is actually equivalent to owning the security outright. Economically, there may be tax advantages, there may be liquidity advantages for doing it this way. This is what I mean by the financial revolution, okay? Being able to run a pension fund without holding any bonds outright, okay, but instead holding the risks outright here. That's the idea. But notice this asset manager, when you create an entity like this and you start trading like this is a new demand for money, okay, that didn't exist. This is not transactions demand. This is not precautionary demand. These aren't the demands that are in our textbooks, okay? This is collateral demand, right? This is demanding something that you can use as collateral for topping up your margin calls on these. That's why they're holding that, okay? This is equivalent to holding mortgage-backed securities outright. So it's not investing in safe assets in order to buffer a risk. This is the risk over here. So this is a new demand for money, and this is a demand for risk, basically. The demand for risk shows up here in the derivative dealer. The demand for money shows up here. So the dealers are facing this new demand for money and this new demand for risk, and they're absorbing this order flow on their balance sheet. The shadow bank over here is just on the opposite side, okay? It's supplying money, it's supplying risk. It's taking mortgage-backed securities and it's carving them up and supplying them. So the asset manager and the shadow bank are just mirror images of each other, and these two dealers are standing in between them. Two kinds of dealers. This is a sort of abstract image. As you know, in the actual world, when we were doing shadow banking, there was all this crazy, tranching and all kinds of things. So it wasn't as simple and clean as all of this. So this is an attempt to say, well, if we made it very simple and clean, what would we do? And that helps us understand it. But we could imagine that that's what the system was trying to do. It was trying to move risk around, okay? It was trying to create riskless assets that could be funded in global dollar money markets. Well, so now let's think about the dynamic order flow. In a world like this, if the asset managers are demanding more money and more risk than is out there, this is going to change the dealer's balance sheet. It's going to cause an imbalance in the dealer's balance sheet, which is going to push prices around, the price of risk and the price of money, push them away from fundamental. It's also going to push the dealer's balance sheet away from matched book, okay, because they have to absorb the imbalance. So we just think of these dealers as having two pieces of the book. One is matched, and the other is their exposure to price risk. The Volcker rule is the idea that dealers should only be focusing on this, and somebody else, maybe a hedge fund, should be taking the speculative risk. So when I say dealer, I just mean somebody who's taking this balance sheet, not somebody who calls themselves a dealer. They might be a hedge fund, they might be a day trader, right? Just to be clear about that. And the reason so I like the Volcker rule from the point of view that it helps us distinguish between two kinds of risk involved in the dealing business. One is liquidity risk, okay, and one is price risk, okay. Liquidity risk, the backstop has to be the central bank, okay. Price risk, no, that's what capital is for, okay. So we're distinguishing these two issues. So the backstop of the central bank we're now coming to. So I'm showing here the global money dealer. This is from the previous diagram, and I'm showing the derivative dealer, okay, just as before. And now I'm putting in explicitly, okay, the liquidity backstops that these entities need. I'm putting them in as contingent assets on the balance sheet of the dealers and contingent liabilities on the balance sheet of the central bank here. I'm going to make that. So this is the way I think the system actually works today. And let me just show you. This is the Fed during the crisis. This is the balance sheet of the Fed, assets on the top, liabilities on the bottom as negative numbers. The two vertical lines are Bear Stearns and Lehman AIG. And you can see how, in the first phase of the crisis, the Fed just lowered interest rates from 5 to 2%. In the second phase, it sold off its treasury bills and lent the proceeds to broker-dealers and so forth around the world, okay, to Royal Bank of Scotland as well, okay. In the third phase, it expanded its balance sheet on both sides. This is the phase when it became a global crisis, really, and the Fed is basically taking the global dollar funding markets onto its own balance sheet, offering these excess reserves, now, you know, 1.5 trillion excess reserves. And you can see there, this one, central bank liquidity swaps. This is where the Fed lent $600 billion to foreign central banks, to the ECB, to Swiss National Bank, and others, which lent it to European banks that needed dollar funding and were being blocked out of dollar funding. This is something that the Fed sort of never imagined it was going to have to do, and here's another thing it never imagined. This is $1 trillion worth of mortgage-backed securities that the Fed bought, okay, in QE1. The people talk, at least in the United States, they talk about, well, quantitative easing. People who say quantitative easing are typically talking about the liability side, okay. There's this increase in high-powered money, you know. And then Bernanke says, no, it wasn't quantitative easing, this was credit easing. So saying people were locked out of the credit markets and we provided loans to them, okay? From my perspective, both of these things are true, okay, of course. Both sides of the balance sheet expanded. But more generally, this is dealer of last resort. This is the Fed offering its balance sheet to people who used to meet in the market, okay? They used to meet in the market, now they're meeting on the balance sheet of the Fed. With the Fed in between them. It's acting as a dealer standing in between these two counterparties. So this is the transformation of the balance sheet of the Fed. Now I want to connect this up to what I had before. See? Here's what the balance sheet of the Fed looked like in December 15th, 2011, sort of after the crisis was over. These treasuries are mostly long-term bonds by that time, and we have about $1 trillion of mortgage-backed securities. And there's $1 trillion of reserves, $1 trillion of currency, and 1.6 of excess reserves here. And I'm just doing a little bit of an accounting exercise on the right-hand side, this restatement, where I add here risky securities, I put as 0.9, that's the MBS here, and I add treasury bonds to the right-hand side, 0.9, and add them to the left-hand side as well. So now instead of 1.7, I have 2.6. That's plus 0.9. And then I add treasury bills, 2.6 on this side, and treasury bills, 2.6 on this side. And then I add currency and reserves up, and I just book them here as 2.6. So I haven't actually done anything to this balance sheet. I've just added and subtracted things from both sides. But the point of this is to show, well, what is this line, these brackets now? If I'm long risky securities and I'm short a long-term riskless treasury bond, what is that? Okay, that's a swap of IOUs. That's a credit default swap. That's the sort of risk exposure of a credit default swap. I'm long a treasury bond and short a treasury bill. What is that? That's an interest rate swap. Okay? And I'm long a treasury bill and I'm short money here. Okay, that's like the overnight index swap. Okay, so the Fed is in fact, its balance sheet in fact, okay, looks like that. Okay, where these puts have come into the money and now they're showing up on the balance sheet. Is the point. Now it didn't actually do this with derivatives because it's illegal for the Fed to do it with derivatives, okay? But it did it outright. These are synthetic swaps in a kind of funny way. But it's backstopping the modern shadow banking system. That's crisis. I have another 5 or 10 minutes. What do I have? 5. So now I want to just just point out some things about normal times. Put crisis aside, and think about plumbing and collateral and things like this. Partly this leads into Manmohan's discussion here. So I'm putting some numbers on this now. This is the same diagram I had before, but I'm now thinking of $100 worth of mortgage-backed securities and $100 worth of funding, and these swap arrangements are zero value at the moment. It's just when the underlying moves, these things are going to come into the money or go out of the money one way or the other. I'm abstracting from counterparty risk, but here's where some of the collateral flow issues come. Thinking of these residential mortgage-backed securities as securing this funding, and maybe passing through, in fact, and securing this deposit here. Okay, so that there's an asset that is in back of that. And similarly, these derivative exposures are, this person is using it as a hedge, right? So if the mortgage-backed security goes up, the credit default swaps go down, so they're perfectly hedged. So there's no risk there in price risk. And the asset manager is taking all the risk, but they have $100 worth of deposits, so that even if they lose all their capital, they can easily transfer it all to the capital funding bank here because they have $100 worth of deposits. All their capital is in deposits, is in liquid reserves here. So this is a model, again, to just abstract from counterparty risk and understand only the liquidity risk that's involved here. And the liquidity risk that's involved is about getting this collateral to flow, getting these mark-to-market things to flow without causing trouble. So here's an example of a value fluctuation where the mortgage-backed securities fall in value by 10 to 90, and the CDS correspondingly rises in value by 10. So the total assets of the capital funding bank are the same, but this could cause problems for its funding, because if it's using the mortgage-backed security as security for funding, where 90 can't be security for funding of 100. That's not gonna work for you. And so it's got to somehow use this credit default swap as a source of funding as well. That means these deposits have to flow through, or something has to happen. There's various payment flows and collateral flows. Now this may be reversed. These are fluctuations in value. Okay, they're just fluctuations. But if they're permanent, there has to be a payment. Okay, and when this payment happens, you can see that the money supply in the whole economy shrinks by 10, because at least in this simple example, the money supply is actually equal to the total capital, actually equal to the total amount of residential mortgage-backed securities. And that involves a payment flow. So there are payment flows and collateral flows that need to be that need to happen without any slippage. And if there is slippage, I don't get paid and I'm supposed to make a payment, this whole system can break down and you have to liquidate some of your assets, and you have a fire sale, you have a liquidity problem on your hands. And I take it that this is a task for the central bank a little bit too. So now I'm adding two lines. This is my original diagram. I'm now adding the liquidity put in for the dealers. Okay. That was for the crises. And I'm now saying, now we've come up with some reasons why you might want to have a little capital on the balance sheet of the global money dealer. Why? Because they can't always have matched book if they're going to absorb mismatched order flow. Okay, so they're going to be facing some price risk. So you're going to probably want to have some capital on there. Also, they're going to be facing some liquidity risk. You don't want them to be running to the Fed for everything. So you might want them to have some reserves here. And the same is true of this derivative dealer here. Okay, so this is now a more realistic picture where it's still the case that the real backstop of the system is here, this capital. This is an important diagram, again, to connect to what we were talking about last night. The capital in the banking system, this shadow bank here, still has no capital. There's no capital there at all. The capital that is supporting the risk is on other balance sheets. Okay, it's on the balance sheet of the dealers, it's on the balance sheet of the asset manager. In fact, I've rigged this example, so it's 100% capital. There's no leverage in this system, actually, right? All of this capital would be lost if the RMBS went to zero, okay? So this is actually equity finance, but it's distributed, and so you don't see that it's equity finance. It's not equity finance in any particular entity. Two more slides. So this is just to remind you, and maybe we can talk about this, that I have abstracted from FX risk. And if there's FX risk, because this is a dollar funding system, the central bank is going to be on the hook for that too. And no central bank except the US can create dollars, so there has to be some access to dollar funding risk, and that's either through the through the Fed or through this liquidity swap arrangement, unlimited liquidity swap arrangement of the C5, I call them. I say, forget the G7, watch the C5, Bank of Japan, SMB, Bank of England, ECB, the Fed, or the IMF if you're lower down the hierarchy and you don't have access, have a special relationship with one of these people. This is just a summary slide at the end, saying central banks at the crossroads. Dealer of last resort is sort of the relevant concept, not lender of last resort. That means supporting markets, not institutions. That means outside spread, not inside spread, so away from the fundamental price. Core assets, not all assets. You decide which assets. The plumbing issues, which we talked about, and this is just moving forward. If we're in a budget moment, we're going to be building monetary policy on top of this. We're going to be building an inflation policy, unemployment policy. The price of reserves is still an instrument, but also the price of this liquidity put, okay, is an instrument that I think will be increasingly important in the operation of stabilization policy.